Hey everybody, welcome to Refinitiv LPC's weekly videocast. My name is Fran Beyers. I am the head of analysis covering middle market loans at Refinitiv LPC.
I'm David Brooke. I'm a reporter covering the middle market at Refinitiv LPC.
And I am Andrew Hedlund, also a reporter covering the middle market at Refinitiv LPC.
So 1Q20 BDC earnings season is upon us, and the first call is going to get kicked off mid next week on April 29th. We have taken the liberty of providing you a schedule of all the calls that are happening next week in case you want to dial in. You can also download these slides on Loan Connector in this week's Middle Market Weekly. But this is likely going to be probably one of the most interesting earnings seasons we've seen for the BDCs since the Great Financial Crisis. So we wanted to highlight for you the main themes we think you're going to hear this quarter. First and most obvious theme you're going to hear about is net asset value and total portfolio asset level declines across the entire BDC universe. So the chart on the right shows you Refinitiv BDC visible loans benchmark. This is a cohort of about 20 billion in first and second lien loans with mark-to-market pricing held by the BDCs. And you can see here that the average bid right now is at about 80, down from the 92 area back at 1231. And also several BDCs have also already come out and provided guidance on NAV per share declines, which you can see here on the chart on the left, ranging from a low of 7% to a high of 32%. And I have to thank Robert Dodd at Raymond James for doing a great job of putting all this into his research over the last few weeks. This implies that portfolio asset level declines are going to be in the 5 to 21% range for 1Q.
Yeah, so on the low end, you have TPG specialty lending, which is down around 7% to $15.57 as of March 31st. And then you have on the other end, THL credit, which is down about 30% from year end to April 15th. That's sort of the gamut. And you have TPG has always been one of the well-performing BDCs, so that its NAV down slightly less is not a surprise per se. But what was interesting was Josh Easterly, the CEO of that BDC, said in a letter to shareholders that they believe there's a lot of underestimation of the amount of capital destruction given the economic decimation from the COVID-19 pandemic. So when you look at the situation we're in, it's going to be a gamut, I think, of BDCs dropping a lot or relatively little on the NAV per share front.
Yeah, and I think FS Energy was also pretty interesting in that they provided some guidance about how banks are going to act over the next 1 to 2 quarters. So this was one of the first BDCs to come out and amend their facility with their banks. We saw them having to suspend financial covenants near term. The banks jacked up their interest costs and also put a restriction on their ability to pay cash dividends, and also required them to pay down part of the credit facility. So the banks have always come out and said, you know, we're going to remain patient. We're not going to force asset sales on the BDCs, as that typically just results in a worse outcome for everybody involved. But I think we're going to see more banks come out over the next 1 to 2 quarters and ask for pay downs as they want to take their risk off the table.
I think you're right. I think Fran and Andrew, you outlined 2 BDCs that have had a very different impact from the coronavirus pandemic and the way it's had an impact on the overall US economy. I think that's likely to translate into dividend cuts across the market, whilst possibly kind of affecting BDCs in very different ways. We've actually already had some announcements on that front. So Golub Capital, one of the largest BDCs in the market, announced it cut its dividend by 12% down to 29 cents per share from 33 cents. At the lower end of the middle market, you have Gladstone Capital reducing its regular dividend to 19.5 cents per share from 21 cents per share. And Main Street suspended its biannual dividend, albeit maintaining its regular dividend. THL Credit is poised to also cut its dividend. This is all a consequence of the likely spike in non-accruals. Even in some of the good assets in certain defensive sectors that BDCs traditionally target, even good companies are being hit by the economic shutdown. The ability to pay debt is going to be hard, putting further pressure on BDC's overall earnings for those better companies. But as one analyst told me, you've got to get these cuts right the first time. cut once, not twice. The market expects a cut, so BDCs need to scale that appropriately to keep investors on side. We might see some come up in the upcoming quarter, while others may drip over into the second quarter earnings. So we'll have to see and wait for the full picture. But of course, to get this right, you're asking BDCs to do the impossible, to make an assessment of the COVID-19 and the US economy over the next few months.
So lastly, I think amid a wave of falling NAVs and dividend cuts and portfolio problems, we have seen the SEC come out and attempt to provide BDCs with some temporary regulatory relief to basically allow them to potentially raise senior securities for incremental liquidity to help preserve their portfolio companies. So I've outlined the math here on the slide, courtesy of Compass Point Research. Thank you very much, Casey Alexander, for making this much easier to understand for all of us. Effectively, the SEC is turning a blind eye to the markdowns at 331 by allowing the BDC to recalculate its asset coverage using a more favorable portfolio value so that it can issue senior securities for liquidity. I've chatted with quite a few sources in the market, and not too many folks think that the BDCs are going to adopt this relief because it comes with a lot of strings attached, right? So it prohibits you from making new investments for 3 months, and it also limits the transaction fees that the BDC can earn on any issuer within the relief period.
I think you're right. I think that the word on the street is this is largely not an earth-shattering move from the SEC. It certainly will not have the ripple across the market as the increasing on the regulatory leverage limits did a couple of years ago, and that BDCs have been increasing the leverage as a result. But it does put us on uncharted territory, and that's worth noting. The infamous Howard Marks said in a recent memo that we're in a regulatory wonderland, with the SEC not demanding financial statements have to be accurate or up to date. And some are going down this rabbit hole now. Prospect announced it would adopt this measure. I think it's worth considering the context here is that a BDC is one of the few not to yet get approval to increase its leverage to 2 to 1, still maintaining the old regulatory leverage limit of 1 to 1. Currently, as the fourth quarter 2019, its debt to equity ratio was 0.64 times. So Prospect is maybe close to hitting its permitted 1 to 1 limit if valuations of assets have declined. But the BDC is in the process of changing that to 2 to 1 with a stockholder meeting next May to raise it to bring it in line with the market. We'll have to see how that shakes out and if others are encouraged to join Prospect in adopting this relief measure. But the regulatory pressures are raising liquidity questions in the BDC market.
And a lot of those questions, BDCs are taking different tacks of broaching that topic of liquidity. You have the BDCs of Bain and Golub. They're each carrying out a dilutive rights offering. Golub is set to raise $400 million below NAV per share, and Bain has yet to announce its price, but it will likely be below NAV per share as well. THL Credit is set to issue around $30 million of equity at $534 a share, which was its book value as of April 15th. But again, that's down about 30% from December 31st. Apollo is also halting its share buybacks. That's in part, according to a fund manager, to guard against write-downs. And so leverage is also an issue for BDCs, and Apollo and Bain are among the two more highly levered BDCs, meaning that they're susceptible to breaching leverage ratios if the write-downs in Q1 or perhaps even Q2 are severe enough.
Great stuff, Andrew and David. Thank you so much. And thank you everyone for listening. We will be providing more BDC coverage throughout the earnings season. Be sure to check David and Andrew's coverage on Loan Connector or BDC Collateral as earnings come out.